Welcome back, everybody, to the Four Star Podcast today. Brian Kasal, CEO of Four Star, your host. And today we're going to explore the mortgage market and what's going on with real estate financing. We have a very special guest here today. We have Kelly Price with us. Kelly is an expert in the mortgage market. She's a super mortgage consultant with Wintrust here in Chicago. She's a top producer in the mortgage industry and also a really great advisor to families and individuals in dealing with mortgage and mortgage financing. So, Kelly, welcome to our podcast today.
Good morning, Brian. Thanks for having me. Great to see you. You look great.
Thank you. You do too. And welcome. There's just so many crazy things that have been going on because of this pandemic. And I know we did a discussion about a year ago, and it was madness back then. And so now we've had a whole year. We're coming out of the pandemic, and what do we expect? What is going on? So a lot of different subjects. So the first one, Kelly, is we were doing kind of a pre-discussion, has to do with interest rates. Like what are people thinking about interest rates, right?
Well, they're starting to get more nervous, Brian, because we all kind of feel like we're on borrowed time a little bit.
Right.
With how low interest rates have been, and so just as soon as the talks of inflation have every impact. Someone hears, oh my gosh, we're talking about inflation. So that must mean interest rates are rising. And it hasn't necessarily meant that, but we're trying to push up from the bottom. But it has everything to do with, right, how well the economy is doing. And if people feel confident in their jobs, I mean, that's not new, right? That's not new information. That's the way it's always been. Are lenders still giving out interest rates under 3%? Absolutely. All day long. Money is still, very dirt cheap. It's just a question of when are rates going to rise and not fall back. And so, it's very normal for interest rates to rise an 1/8 to 1/4%. There was a point, I'd say maybe late May, early June, when the robust spring market was peaking and we were pushing up towards mid 3s. And then we fell backwards. They extended the stimulus. The workforce is still not back to pre-COVID levels. And my opinion is until that happens, we're not going to see rates have that ability to push up.
Okay.
So low 3s, high 2s.
Okay. So we keep reporting on price inflation on the Four Star Podcast episodes. And, we're obviously seeing automobile prices go up and real estate prices are going up, record levels now of home prices. Even food commodities, like a favorite of Four Star listeners is bacon is up 13%. So everything is up.
All right.
So that would normally lead to higher interest rates, but we've been seeing interest rates recently just fade and go back down a little bit.
Yeah. That's a lot of bacon, though, that would have to be consumed to drive those rates up. I'm not against it. I'm a fan of bacon, but I think that, to drive it up, we're gonna have to see some really, really good news. And I think by and large, our business owners are still hurting. Our inventory, even though businesses are open, right, our inventory is low. And so it's just, mortgage rates really follow those economic signals. And there hasn't been enough continuity of it to pull up those rates. They're going to at some point, and you're the one to go to and check in on, when is a better indicator of that when, economically speaking, but it'll happen and it'll help us all also kind of level out pricing, because you have a lot of people sitting on the bench waiting for prices to kind of stabilize, because there's a lot of people that don't want to overpay for real estate right now.
Yeah. So do you think
on the sideline?
We did a video and a podcast about real estate prices a couple of months ago, and it was one of the most widely watched one. And we asked, are home buyers overpaying right now? And does it look like that might be happening because money's cheap and everyone's piling into real estate and buying over listing and all that? Do you think that's possible, Kelly, that people might be overpaying a little bit here?
I think that the answer to that question is depending on what the margin is. Are they overpaying based on what prices have been? Yeah, they're overpaying based on what prices have been. But that's your, again, basic supply and demand, right? If you have, there was a massive demand created, right, during COVID. And that was, I'd say the number one thing was space. And then on top of space was your lifestyle, right? So this past year, what really changed and I think opened a lot of people's eyes was, if I'm going to upgrade, resell and upgrade, or if I'm going to buy because my rental situation is too small, I need to make sure that I've got enough space for it. And so that created a lot of demand. And then you also had people kind of reanalyzing their life and their lifestyle and where they're living and moving. I read an article recently that San Diego, Denver, and Phoenix were the hottest cities for the residential market over this past year. I wouldn't have said that because I know so many Chicagoans that took off for Florida. It's not even funny, right? When we all know the incentives financially living in Florida. So that market, Florida has bubbled before, right? There's been other U.S. markets that have bubbled. And unfortunately, the interest rates kind of being so low kind of feed into that ability to bubble and name your price. But I think just as important, Brian, as the interest rate conversation for mortgage and finance is the appraisal conversation. If you ask any mortgage lender out there what the most challenging part of lending during the pandemic has been, it's been the appraisal process for a couple different reasons. Number one, during the height of the pandemic, who wanted to let a complete stranger in their home to snap a couple photos, right? That was a challenge. Freddie and Fannie, the secondary market out there, came out and started giving waivers. So that's pretty risky. You could actually not only refinance, but you could buy a house without even having it appraised. And that only really happens in really stable, that very stable rising real estate environment. And so appraisers were losing money because banks weren't paying them as much to do what's typically a robust refi boom. Appraisers make a ton of money, right? Banks make a ton of money. They felt, deprived a little bit. And then you get this robust spring market that ultimately tells these appraisers, we're on fire right now, and I need you to do this and that like yesterday. And there's no control. I mean, the prices have gone way up there. So things have gotten competitive with rates, but the cost of doing business has risen because of the lack of individuals and time to be able to get everything done.
So do you think that kind of weirdness in the appraisal market might have even helped cause some of the price increases where they're not really appraising things like they should have, and they're just like buying and bidding and going for it?
Yeah, we see appraisals every day that they're not necessarily supporting value. You give an appraiser a purchase contract and they've got to hit that. They're trying to justify that value that either the agents put out there or there was a bid war, right? And they attacked that and just kind of came to an agreeable price, but no one knows if the value's there. And so it's a challenge because banks aren't just accepting appraisal reports that aren't justified. So it's that appraisals are always going to be a layer of protection for people financing homes. We learned something coming out of the mortgage crisis that the CFPB will never let us forget, Brian. Trust me, we did learn things.
That was 10 years ago, wasn't it?
Oh my gosh. Yes.
Okay.
It was like yesterday though, but it was a long time ago.
Those lessons.
I don't think we're headed there. People ask me that. I don't think we're headed there. We've really truly learned our lessons on a lot of things.
Good. Now, we talked about long-term rate locks too. Now rates are fading down. And where did you say the general mortgage were for what qualifying and then jumbos? What are the ranges now generally?
Yeah, most conventional mortgages with great credit scores, you can get under 3%, fixed or adjustable. But if you're in the jumbo arena, credit is more, the requirements are higher with credit standards, and you'll see scores in like the low threes. There are higher interest rates out there where people are high threes, low fours, and those are typically for your not so ideal credit ratings or even your renovation financing. Renovation financing on like the good old fashioned 203K, it's hard to take on reno right now because the contractors are slammed. But at one point, I don't know if you know this, at one point last year, because in the height of the pandemic, the government felt that no one should be doing construction. So it shut down and they raised rates through the roof on like 203K and other types of standard renovation financing. And so I literally gave out I'd say late spring, early summer, I gave out renovation rates that were almost 6%. And the point was the government was trying to price those products out of the market because they didn't want to deal with them. They didn't have the manpower, and they just wanted it to shut down for a little bit. So we're not there. That's all come back, and it's a robust renovation market. But we've been there and back already.
So that might have even caused part of the home price increase, because people weren't renovating, right? And so a lot of the builders weren't building as much. And okay, so that's interesting how that dynamic is playing out. So the long-term rate lock, then people may say, how would they do that? They would say to you, we want to refinance and we want to lock in this rate for a long time, like 30 years.
I love that you brought that up, because that just the concept of long-term rate lock, it hasn't even been around. Like, no one's been talking about it. Okay. Certainly mortgage debt will be fixed for 30 years, but a long-term rate lock is going to be something that's beyond your typical lock. So when you go to buy a property, you're going to lock in for 30 to 60 days. That's very standard. But if you're buying new construction, and Chicago and a lot of these robust markets, definitely Denver, Phoenix, San Diego, everyone's delivering these, finally developers are getting caught up on material, right? The material shortages that everyone's been dealing with. And so when they were originally, so you've had buyers under contract for quite some time now when you sell out these big developments. And the delivery dates have been pushed back based on not only material, but labor delays. And people that thought they were going to be able to lock in, under 3% and buy new construction, meaning like a win-win, right? Interest rates, tons of equity, which is the concept of buying new construction. Now they're nervous because they're concerned of market peaks, and they're nervous about interest rates going up, and not necessarily feeling that in their pocket from a compensation and employment perspective. So people are considering, for the first time in a very long time, when they buy new construction real estate, they would do a lock period for anywhere from 6 to 12 months. They pay a premium to do that. But we offer these really fun float down options. It's kind of like an insurance policy on your rate lock. Put a little bit of money on deposit, lock in at a rate just above market. And then depending on when your property delivers within that 6 to 12 month period, if the interest rates are lower, and so you put that deposit on that hedge, that if they're higher, you win. If they're lower, you get to float down. And nice. Money back after you float down. So you get to float down to market rate if they're better. So this is something that people are considering. Do I want to hedge my risk against when interest rates are going to go up to protect myself, my monthly payment, and what I initially intended to invest in? So it's a hot topic for new construction.
Then once they actually buy the property or do the construction, then they convert that to a mortgage. Mm-hmm. Then they can, like a longer term, 30-year, 15-year, right?
Oh no, this is the 30-year fixed rate. This is This is just to lock and protect them while they wait for the property. So if you want a 30-year fixed rate if you want a 30-year fixed, Brian, and you're waiting for your new house to be delivered in 6 months, I can qualify you at a rate of 2.75. And you're excited about that. But that means nothing if interest rates are 3.75, right? Sure. When we deliver it this fall. So if they so the concept being, we can lock in at maybe 3%, which sounds a lot better than the potential 3.75, and then you'll have that rate for 30 years. Oh, nice.
So that converts to the rate. Interesting.
You got it.
So we talked about cash buyers, and you're thinking that cash buyers are changing the market dynamics a little bit here too, right? There's a lot of cash buyers now.
There's more than I think a lot of us have expected, but I don't know where all the money's coming from. I'd have to refer back to you on that one.
Yes. Well, there's a lot of we've done a piece on helicopter money. There's a lot of child care payments now and $600 stimulus payments. And so there's a lot of money out there for sure in certain hands. Mm-hmm. But you've seen that. You're in the mortgage business, but you've seen the cash buyers creating disruption in the real estate markets, right?
Mm-hmm. Yeah, you're not going to win against cash. Every seller that's got their property on the market wants the highest price and the fastest close, right? Who wouldn't in a fast moving market? Because that seller's got to move on and move quickly to get the bid on the next property, right? But the one thing, I may have said this before last time we chatted, a lot of my cash buyers out there, and I don't care what the price point is. I don't care if it's a quick 350 or if it's $2 million. People are paying for real estate in cash, and then they come back to the mortgage bankers and they ask for, let's put a small mortgage on there. Rates are still fantastic, right?
Right.
Well, they are. But what people forget is you pay a premium on an interest rate on a cash out mortgage versus
Right.
a purchase mortgage.
I see. Yeah. Okay. Interesting. So it's not that easy to just come and say, hey, give me a mortgage now.
It'll work, but they should always try to pre-qualify themselves, because people just assume, well, the last time I got a mortgage, maybe 10 years ago or even 5 years ago, I should be able to get a mortgage again. And I wish that was the case. But the danger is you could end up putting way too much equity in your home, having your equity trapped. If you're a business owner, you're going to at some point need money, access to that equity. And you're going to end up overpaying on the interest rate when you could have just taken the mortgage for the purchase that would have saved you some interest over long and short term.
Yes. Interesting. Yeah, you would think you could just get a mortgage, but maybe you can't.
We try to make it more of a cup of tea than it usually is.
Yeah. Well, and Kelly, on another subject, we were talking earlier about the moratorium and deferments on mortgage payments and student loan payments and everything. What do you know about that? Our economist had talked a little bit about that, but when do you think that's going to end, and what does it all look like at this point?
Oh my gosh, warning, it's coming. It's, the forecast is it becomes a hot topic here in the very short future, right in the next 30 days. And then the fear is if you're deferred on your mortgage or your big student loan debt, come September 1st, I think student loan debt is the end of September, but September is going to be a crucial month for anyone that's deferred any type of financing or credit obligations. It's going to be key to people's literally next 12 to 24 months, because that's how long negative derogatory information on credit can harm people. It's going to be crucial that people, start paying attention to what's going to be happening, what's coming due, so as not to damage their next move.
Right. So while we're talking about deferring of payments and such, but at the same time, we're talking about all these people with cash out there. Well, all those people with cash aren't having a problem, but it's the people who lost their jobs or they're just getting a deferment because their incomes are down, right?
Anyone was eligible. You probably know just as well as I do, there wasn't that big of a qualifier. As a matter of fact, some mortgage servicers were proactively calling, asking if people wanted to or needed to be put in deferment. And when clients who I've now had to try to help refi or help with a new pre-approval, finding out that they were in deferment or how they transitioned out of it, even though lenders were not allowed to report people late. This isn't, let's be clear, it wasn't your standard forbearance or deferment that people were in.
Right.
Lenders are not allowed to report it to credit. So that's the biggest takeaway. Lenders are going to now be able to report it. Lenders people forget that lenders have to verify on-time payments. And so if you were in forbearance, you may not meet that minimum period of having on-time payments. And so people may say, well, I just saved, whatever it might be, Brian, extra money for the down payment to purchase the new place, but they saved it because they were in deferment. And then they didn't realize that they were taking away their on-time payment requirement for the new mortgage. So it screws up the timeline.
It does. Yeah. Wow. That really would. So September is when a lot of these deferments are ending. And so there's going to be foreclosures maybe, or maybe people just have to pay the bill. Right. And it's going to change a lot of things. But it's we talked about this on the podcast in the past that, last year we basically shut down like 40 to 50% of our economy, but the rest of the economy was fine. Financial services was fine. Mortgage industry was fine. So a lot of industries are fine. So it's really confined to those people who really either lost their job or they're making less than they were, right? For one reason or another. You see a lot of really distressed buyers and distressed people in this environment, right?
We do. I think that, the PPP really did help people, not only the businesses, but by taking the PPP, people weren't, they weren't allowed to let go of their employees, right? So although, unemployment is still pretty high, pair that PPP saved your job for now sort of thing. And then you take the stimulus. There were people, I can't say enough, there were plenty of people taking advantage of the deferment that didn't actually need to. Yeah. And then it was there obviously to help the people. And so my point is, instead of having one category of people that it was helping, which was the ones where they had the actual hardship, there's now been created a new group of people that didn't actually need to participate from a financial employment situation that now they're potentially being harmed from a credit or qualifying for the new house and the new mortgage scenario. So it's kind of a double picture that maybe we didn't anticipate, but the rules weren't that stringent and people were able to take advantage of it.
Yeah. So maybe they shouldn't have taken a deferment because it's going to hurt them. Yeah. Interesting. Wow.
One really cool thing, Brian, that I do want to add that I think is a positive that kind of your Fannie Freddie have taken on is that if someone is in deferment and let's say they've been in deferment repeatedly and they've got a new job now with less income. So they need to downsize, they need to lower their budgets. If the house was too expensive, what people are actually being allowed to do is if you've got deferment payments all backed up, but you've got your house appreciating and you've got more equity than you've ever had in your home, to sell it, get a payoff letter from a lender that's going to include your principal, your interest, and your deferment amounts. If you can sell that house and cover everything you've owed to the bank, you're settled. That's not a short sale. It's not a negative on your credit. You can go buy a house with a mortgage the very next day. So there is that saving grace. And right now we're in that period of, if September ends up being, the end all to get back on track or get out of a bad situation, the robust housing market, if that continues and the low interest rates still allowing affordability, will help people get out of a bad situation and start over a lot faster than we saw a lot of people coming out of the mortgage crisis when that happened, like you said, about 10 years ago.
About 10 years? Yeah, way back in the... One other thing we were talking about is how the federal government deals with all these things. And I guess there's a federal law that still requires mail notification, right? And that could slow things down. They don't do things electronically in the federal government anymore.
Not everyone has an email address, Yeah. There's still that society out there that doesn't live electronically. And so all notifications must go to last known mailing address. And so if you've moved, and believe it or not, regardless of pandemic, a lot of people have been moving, make sure your creditors, not just your mortgage lenders, but make sure your creditors know where to find you. Because if they don't, and the notification is sent to that mailing address, we all know what a door knock collection looks like months later when they find you.
Absolutely. Well, and the mail system's been somewhat stunted too. So we've had trouble with the U.S. Postal Service. So a lot of interesting things all kind of happening here at once. And so it sounds like September in the mortgage market's going to be a big thing to think about. People are going back to school. Then a lot of the helicopter money, as we call it, the unemployment payments, are going to start ending. Some states have already ended it. There's some lawsuits to try to keep it going, but a lot of it's been ended. But then all the other states, unless they extend it, should end in September too. So then maybe more people would be going back to work. So a lot of like back and forth, positive and negative things are all going to kind of hit at once. It's going to be an interesting month, September, isn't it?
It really is. And then also October, just because to talk a little bit more to the finances with our business owners, right? A lot of people were on extension because COVID just hurt a lot of people. And so if you had a tough year, you're on extension. And when those results start coming out, that's also going to have a pretty big impact because business owner, your financials with your tax returns and your year-to-date financials translate into averaging. That's going to have an impact on, what they might be doing personally with their home finance. So that'll be September, October will be credit as well as, bottom line figures for what the heck happened in the midst of the pandemic fog. It's all gonna get washed out yet this year, like it does every year, but it'll be different.
It'll be a little different. Yeah, it's interesting. Well, the the after effects, the wake of this pandemic still is going on. There's still many things going on, and so it's good to talk with you today, Kelly, and just get some insights on what you're seeing on the front lines, working with individual investors, trying to figure out how to help them get into a home and deal with all the other issues that go along with it. It's been pretty crazy environment, but thanks to you for being with us today, Kelly, on the 4-Star Podcast. We really appreciate it.
I'm happy to be here. Anytime, Brian.
Yeah. All right. Check in with you again. I appreciate it. And we'll check in with Bob Barone, our 4-Star economist, and tell him what you told us. And we'll see what he has to say on a later podcast as well.
Wonderful. I look forward to that.
Thanks, Kelly.
You're welcome.
Thanks for with us. And thanks everybody for being with us on the 4-Star Podcast. Don't forget to give us a 5 out of 5 rank and tell all your friends and sign up for a regular subscribership on Apple iTunes or any of the other services, Spotify, Stitcher, and all the others. So thanks again, everybody, for being with us on the podcast. And thanks so much, Kelly.
Thank you.